I'm joined by Paul Donovan. He's Deputy Head of Global Economics at UBS Investment Bank. So, Paul, thanks very much for coming in.
No problem.
Let's start out with the BOE. This is said to be perhaps their most difficult meeting in 13 years since they took over the responsibility for setting rates. I mean, do you think that's the case? Do you think it's time to start tightening, as some people argue? Or do you think perhaps we could be seeing more QE ahead?
Frankly, I think quite a few of the meetings in late 2008 were probably a little bit more difficult than today's, when capitalism was on the brink of collapse. This is not, I think, that difficult a meeting, to be perfectly honest. On the one hand, we did get a very good second quarter in terms of growth. But on the other hand, we know we've got significant fiscal tightening coming through. And we shouldn't underestimate this. I mean, this is an unprecedented degree of fiscal tightening, not just for the UK, but in modern history anywhere in the world. And how the economy is going to react to that is something that's going to be very important for the bank. So I think that we are actually going to see caution. I don't think that there is actually going to be a great deal of debate. Doubtless Andrew Sentence will keep on going on about inflation risks. He's the only one who sees them. There aren't inflation risks in the UK. There's no inflation risk at all. Inflation's actually generally coming down. So
you were talking about Andrew Sentence there. He was the guy that dissented, the member of the MPC that dissented and voted in favour of a rate rise last time around. Do you think anyone's going to be joining him this time around?
I think it's quite unlikely. I mean, the inflation evidence really isn't there, aside from the VAT tax increase. Now, most economists don't get worried about tax increases as they're a one-off event. It's not something which causes rising inflation pressures. If you look at CPI excluding the tax increase, not only is it low, it's low and it's been falling in recent months.
But inflation has been running above this upper limit of 3% for 4 months now. Some people say it's going to get worse as well because you have food prices perhaps going higher.
The problem here, of course, is that if you've got a VAT tax increase, nothing that interest rates do is going to prevent the inflation that comes through from a VAT tax increase, because that's done. That's the government deciding it's raising taxes. The Bank of England knows full well there's nothing it can do to affect that aspect of inflation. What it can affect is non-tax inflation rates, and non-tax inflation rates are low and falling.
So you're recommending caution because of the fact that the austerity measures haven't really kicked in yet, and the economy could be headed for a double dip. Would you go that far?
No, I don't think we're going to go to a double dip, but I think that you've got to slow down, and you've got a great deal of uncertainty, and that's the key point.
Okay.
The Bank of England is dealing with an uncertain environment.
Now, let me put this to you. Stuart Thompson of Ignis Asset Management, he says that the US and the UK are going to be forced into a second round of QE sometime within the next 12 months. He says in the UK, most lead indicators have now peaked. The cyclical bounce is finished with. He says perhaps February next year we could see the BOE embarking on QE even bigger than it has over this last year.
It's possible. I think it's unlikely, I have to say. Have the leading indicators peaked? Yes, I should certainly well hope they've peaked. That's what it's supposed to happen at this stage of the cycle. Leading indicators don't go up indefinitely. They go up during the recovery phase, and we've pretty much done with the recovery phase. We're now sort of plateauing out in terms of growth. Now that means that confidence doesn't keep rising. We hope it doesn't go into a tailspin, but it doesn't keep rising indefinitely. What we're seeing in the data, both in the States and in Europe, is entirely normal for this stage of an economic recovery. The problem is, it's been nearly 20 years since we had a serious recession. People have forgotten what it's like.
Very quickly, what's the dilemma over at the ECB today? Are we going to see Trichet try and make another run at the exit?
I don't think so. At least I certainly hope not. They've got plenty of problems coming through. I think we're going to get a lot of smug comment about the bank stress tests, which is meaningless nonsense, and that'll probably be it.
Okay, Paul Donovan, Deputy Head of Global Economics at UBS. We really appreciate you joining us.
Thank you.